What happens when a city loses its future in just 12 months? Right now, across Metro Vancouver, 2,500 brand new condos sit completely abandoned, empty, unsold. That number has doubled in a single year. But here's what terrifies government officials. This isn't just about empty buildings. British Columbia's premier is watching two devastating forces tear apart Vancouver's economy simultaneously. Tech workers are fleeing in record numbers. Investors are pulling billions out of the market, and the provincial government. They're scrambling to stop a collapse that's already accelerating beyond control. Today, we're breaking down exactly why BC's leadership is in full panic mode. You'll see the shocking migration data they don't want publicized. The capital flight numbers that reveal investor confidence has completely evaporated. The tech industry meltdown forcing thousands to abandon Vancouver, and the desperate policy responses that might already be too late. Don't miss a single detail of this unfolding crisis. Hit that subscribe button and smash the like button right now because this situation is deteriorating by the day and you need to see what's coming next. Vancouver's tech sector just experienced something unprecedented. Microsoft eliminated 9,000 positions in July, with Vancouver teams directly in the firing line. Amazon slashed headcount, Meta cut deep. A local fusion energy company that had raised $440 million from investors, including Jeff Bezos. They eliminated 25% of their workforce in one move. The numbers paint a devastating picture. Total North American tech layoffs in the current year exceeded 76,000 workers. In February alone, over 16,000 cuts occurred. Vancouver, deeply integrated into this ecosystem, absorbed every single shock. Hootsuite wiped out more than 400 positions. Shopify eliminated 1,000 workers. Article furniture retailer cut 217 staff. Unbounce reduced its team by 20%. Right now, hit that like button because what I'm about to reveal gets even more alarming. But here's what truly terrifies provincial officials. The workers who still have jobs are leaving anyway. A comprehensive University of Toronto study found that 1 in 4 recent STEM graduates from Canada's top universities now work outside the country. For computer science graduates, that figure jumps to 30%. For software engineering, 2 out of 3 graduates have already left Canada, mostly heading to the United States. Students describe a Bay Area or bust mentality dominating Canadian campuses. The math is brutal. Tech workers in San Francisco and Seattle earn nearly double what Toronto peers make, even before currency conversion. A software engineer pulling down $150,000 USD in Seattle with zero state income tax takes home dramatically more than a Vancouver engineer making $100,000. CAD, after federal and provincial taxes crush their paycheck, Premier David Eby's government is watching the province's best-educated, highest-earning young professionals disappear. These are exactly the people who should be buying homes, starting families, and building British Columbia's future. Instead, they're building careers in California and Washington state. Statistics Canada just released data that sent shockwaves through Victoria. In the first quarter alone, 29,400 non-permanent residents left Canada. That represents a 54% increase compared to the same period last year. British Columbia got hit hardest. The province recorded its first population decline since records began in 1951, losing 2,154 residents in a single quarter. Subscribe right now, because the data I'm sharing next explains why government officials are genuinely panicking. The bleeding came primarily from one source: international students. British Columbia lost 11,742 study permit holders in just the first quarter. These weren't temporary tourists. These were people renting apartments, supporting local businesses, and planning to transition into the workforce and eventually the housing market. Andy Yen, director of the City program at Simon Fraser University, confirmed what everyone suspected. Vancouver has always been able to attract people early in their careers, whether they come for education or a job. But the city has a persistent problem retaining that talent. The federal government's new immigration targets make recovery impossible. Ottawa plans to slash temporary residents to no more than 5% of Canada's population by the end of next year. That means fewer international students, fewer temporary foreign workers, less demographic support for rental markets. Metro Vancouver's population growth projections just got revised downward from 50,000 new residents annually to 42,500. That's a 15% reduction in expected demand. The MBA statistics reveal how quickly sentiment shifted. 15 years ago, 95% of MBA students planned to stay in Toronto after graduation. Today, under 50%, while that specific data comes from Toronto, the pattern affects every major Canadian city, including Vancouver. Young professionals complete subsidized education programs, then immediately leave for better opportunities elsewhere. Premier EBI's government-built housing policy around assumptions of permanent population growth. Those assumptions just exploded. Here's the number that keeps provincial finance officials awake at night. $16.8 billion. That's how much foreign capital fled Canadian securities in a single quarter. The largest withdrawal since the fourth quarter of 2007, right before the global financial crisis destroyed markets worldwide. Drop your thoughts in the comments right now, because what's happening to investment capital will shock you. Bond markets hemorrhaged $10.3 billion. Money market instruments lost $3.6 billion. Equity and fund shares combined shed another $3 billion in foreign investment. When you add first quarter losses of $5.8 billion, total foreign capital flight reached $22.65 billion in just 6 months. This isn't a correction. This is a fundamental reassessment of Canadian market viability. Vancouver's commercial real estate investment collapsed 33% in the first half of the year compared to the previous period. Total transaction volume hit $4.3 billion. A substantial decline driven partly by proposed capital gains tax increases, but mostly by complete investor uncertainty. Domestic investors aren't just sitting on the sidelines. They're actively fleeing. Canadian companies sent $26.8 billion abroad during the second quarter, a sharp increase from $7.4 billion in the first quarter. Approximately half went straight to United States markets. The net portfolio outflow? $43.7 billion in 3 months. That equals the federal government's entire infrastructure budget leaving the country in a single quarter. According to Rennie Intelligence, investor participation in Metro Vancouver's condo market collapsed from 50% of buyers between 2021 and 2023 to just 7% in early 2025. This isn't a gradual decline. It's a market cliff that left developers without the pre-sale capital they desperately need to secure construction financing. Longtime Vancouver realtor Brian Yan described the Westside market as dead, with only 25 out of 464 listings. Between $2 million and $5 million selling in a recent month. Yan personally knows owners from China who sold Vancouver properties and took their money back to China. He calls these reversal of fortune deals, where capital that flooded into Vancouver during boom years now floods back out. The provincial government's revenue depends heavily on property transfer taxes. They're staring at more than $2.2 billion in tax revenue at risk from declining transactions during a record deficit year. Premier Iby's team has no good options. Cutting taxes to attract investment would explode the deficit. Maintaining current policy means watching revenue collapse. Stefan Groyer, vice president of Zonda Urban, the major presale tracking firm, stated bluntly, that's a big collapse. He's talking about Metro Vancouver's presale market, which just experienced a historic meltdown. The region recorded 1,472 presales for high-rise concrete condos in the first 2 quarters. At that pace, Vancouver is tracking toward a 20% decline from last year and a 53% decline from 2023. Only one concrete high-rise project launched in the second quarter. Overall pre-sales, including both wood frame and concrete buildings, crashed 50% below long-term historical averages. Hit that like button because the financial carnage I'm revealing next shows why recovery seems impossible. Of the 16,589 pre-sale units currently on the market, more than 61% sit in what industry insiders call the danger zone. These projects lag far behind the 70% pre-sale targets needed to secure construction financing. Developers need to pre-sell roughly 70% of units before lenders provide construction loans. When projects fail to hit that threshold, they get canceled or indefinitely delayed. The consequences are already visible. The 60-story curvy luxury project in Vancouver's West End from Bavia Group appears headed toward insolvency. Tangerine Developments converted a 379-unit condo plan into rentals in Surrey. Westbank converted a 294-unit condo tower in Newark, Westminster into rental using a $135 million loan from Canada Mortgage and Housing Corporation. More than 22% of land sales over $5 million in the first quarter were ordered, doubled the same period last year. These aren't normal market transactions. These are distressed sales where lenders foreclosed on properties and are liquidating assets to recover loans. The region's unsold condo inventory is expected to increase by more than 60% this year. That inventory represents capital tied up in buildings generating zero returns while bleeding carrying costs. Every single month, they sit empty. Daryl Simpson, president of Townline, a major Vancouver development company, told a podcast audience that the current downturn feels more challenging than anything in his three-decade career. He attributed this to years of policy whiplash and the complete collapse of small investors in Vancouver real estate. Those mom-and-pop investors who once provided crucial liquidity to the presale market have been driven out by measures designed to cool speculation, but which also eliminated a key source of development capital. An estimated 100,000 approved homes in Metro Vancouver sit stalled due to financial constraints. These projects received all necessary approvals and permits, but cannot proceed because developers can't secure financing or because construction economics don't work at current costs and projected sale prices. Subscribe now, because what happens next will determine whether British Columbia's economy survives this crisis or enters a decade-long depression. Anne McMullen, president and CEO of the Urban Development Institute, explained the core problem facing the province. It costs more to build a unit or a home than the average person in the Lower Mainland can afford. When construction costs exceed what residents can pay, projects don't get built. Developers need to deliver units at $700 to $900 per square foot to make them accessible to local buyers. But current land values, development charges, and construction costs push LN costs beyond $1,100 to $1,200 per square foot or higher. That gap is unbridgeable without some combination of lower costs, higher buyer incomes, or massive external subsidies. Greg Zadie, president of Vancouver-based development company Rennie, describes the market as out of gas with nothing working for developers or buyers. The current level of developer unsold inventory represents the highest in 24 years. Major firms responded with permanent workforce reductions. Westbank Properties laid off 12% of their team. Rennie Group, the region's largest real estate marketing firm, cut 25% of staff. These aren't temporary measures. These are fundamental reassessments of market conditions and future prospects. The economic impact extends far beyond construction. The provincial government faces revenue collapse during record deficits. Construction workers lose jobs as projects cancel. Material suppliers face reduced orders. Property management companies handle fewer units. The entire ecosystem built around a booming housing market is contracting simultaneously. The Vancouver housing market that existed in 2021 and 2022 is gone forever. That market, characterized by bidding wars, rapid appreciation, and confident investors, operated on assumptions that all proved false. The assumption that tech employment would expand indefinitely. The assumption that foreign capital would keep flowing. The assumption that population growth would remain strong. The assumption that prices would always appreciate. Every single assumption collapsed. What comes next? A prolonged adjustment period seems inevitable, with prices finding new equilibrium based on local incomes rather than speculative appreciation or foreign capital inflows. That adjustment will devastate anyone holding overvalued assets purchased at peak prices. The reset happening right now in Vancouver represents a fundamental transformation of the city's economic model. Premier Eby's government is caught between impossible choices: intervene aggressively and risk exploding provincial debt, maintain current policy and watch tax revenue collapse while constituents lose everything. There are no good options left. The exodus continues. Tech workers keep leaving. Investors keep pulling capital. Students keep choosing other destinations. The downward spiral feeds itself. By 2026, historians will look back at this moment as the inflection point when British Columbia's housing market crossed into territory from which recovery became impossible without revolutionary policy changes or external economic shocks. So here's my question for you. Can this process be stopped, or is there truly no way back? Have we crossed the point of no return? Drop your thoughts in the comments right now because I read every single one and your perspective matters. Don't forget to subscribe, because the continuation of this story is coming and you need to see what happens when this crisis spreads beyond Vancouver into the rest of the province. Hit that subscribe button now.